We're live.
So welcome everybody to the first Hangout of Asset Pricing Part 2. We're ready to go. I'm here, John Cochran. I'm teaching the class. We've got Adam in the University of Chicago, one of our TAs, Nina from St. Gallen, Switzerland, and Charlie, one of our most faithful students, almost acting as a third TA. So I think we got a bunch of your questions ready to go. Let's tear into it. Nina, I think, had the first one, right?
Yes. There is a question from Tihomir Nikolov. The question is a bit technical. He said that when he estimates a VAR, he always gets a matrix with coefficients which contain the lags for each variable. And then he's confused what can he do with all those coefficients for the lags. I think this question refers to the homework in week 3.
Yeah, hold on. I'm just writing, I didn't bring my whiteboard with me, so I have to write some equations, and I'm writing a quick equation. Hold on just a second. So usually, the standard thing one does when writing a VAR is you use. So here's an equation. Can you guys see that?
Yep.
So here's the beginnings of writing out a VAR. Where on the left-hand side I have the return. I have return, dividend growth, and dividend yield, and on the right I have return, dividend growth, and dividend yield. And in fact, the standard thing to do is to include multiple lags of all the variables. So if you read Chris Sims, who invented this technique, vector autoregression is like scalar autoregression. You take all of the left-hand variables, run them on all the right-hand variables, and then on lags of all the right-hand variables, and keep going. So the VAR, the thing I called a VAR that we've been running, has only the dividend price ratio on the right-hand side and no lags. Why is that? Well, because I've run them every which way, and my years of experience in running this VAR has taught me that adding the, if you add the return and the dividend growth on the right-hand side, and the contemporaneous one, it doesn't make a lot of difference. And in fact, if you add lags of return and dividend growth, it doesn't make a lot of difference. What does it do? Sorry, we don't have sexy visuals. Typically what happens is if you have an impulse response function that with no lags, that with just the dividend yield looks like that. That's the A or one of the dividend yield. If you add lags to this system, you typically get something that looks like that. So you get some short order, little bit of dynamics, but then the basic pattern is the same. The long run patterns especially are the same. So, and I'm emphasizing this because I don't want you to take from this lesson, go run VARs with only the dividend yield on it. When you go run VARs in your life, go put all the other stuff on it. Go put the lags on it. But then look carefully. If these numbers are small, and if it's not changing the story, you can simplify it. So I just set these to 0 because I know that adding them doesn't make a difference pedagogically for the big picture for this class. Although you usually add them when you do a VAR. But you do have to, take what's the economically significant part. I will say one more thing. In my experience from doing these things, actually a single lag of the dividend yield, if you add dp minus 1 as a right-hand variable, that actually does that does make a bit of a difference. And there's an exploration in the appendix to discount rates about what happens when you add a single lag of dividend yield. That actually makes a bit of a difference. The other ones don't make a lot of difference. Now, Nina, do you think I answered the question?
Yes, I think so.
Okay. I also emphasize, why are we only using the dividend yield? Again, as the pedagogical simple one, we talked a little bit about adding, as an example, discount rates talk about what happens when you add CAY on the right-hand side, and you saw how that can make quite a big difference. The right way to do things is you add lots of variables on the right-hand side. Now, don't go fishing. This isn't the license to throw everything in there, but the right way to think about this includes other variables as well as variables. So, sorry, Nina, you're about to say something.
I just wanted to summarize that what the students have to do is just to run 3 normal OLS regressions and get coefficients one by one.
Oh, thank you, Nina, for bringing me back to earth. As far as the mechanics of the problem set, right. What we're running is we are running just R on DP without the other stuff, and you can run each of these by ordinary least squares. In fact, if you really, I forget what I asked you to do in the problem set, but because of the identity, you really only have to run 2 of them, and the third one's implied. But in general, vector autoregressions, what's lovely about them is you don't need any fancy econometrics. Even with lots of lags, this is just run equation by equation, ordinary least squares. So you can spiff it up if you want to, but in the end, this is very easy technique, which is one reason I love it so much. I like easy. Charlie, you got any comments? You were the most recent person who's had to deal with understanding this problem set. Help us understand what people found difficult with it and how to explain it better.
No, I mean, it sounded good to me. I followed. I'm good.
Yeah, well, just because you didn't have any problems running it.
I guess, what I've been thinking about with the VAR in general is that we make this, the VAR assumes that in 1927 the beta on dividend yield was the same as it is in 2005, and dividend yields are so affected by policy that I just wonder, tax policy affects, the size of dividend yield on average. And so I've been thinking lately about, is there a better representation, like a state-space representation, where you could allow this beta to move over time, and is that one of the reasons why, when we look at a sample, sometimes it seems that this regression doesn't work very well, or it wouldn't have worked very well in real time. And people have worked on that a little bit.
I want to push back a little. Dividend yields have fallen a lot since World War II. There's this what almost looks like a downward trend. Now, these things are so slow moving. Who knows? Maybe we're just one big crash away from dividend yields going back to the 4 to 5% that they used to be. It's not obvious how tax policy is going to change the dividend yield that much. Tax policy, when the government taxes away your dividends, that's okay, but then people are willing to pay a lower price for those lower dividends. When I think about the economics of this big decline in dividend yields, I think of it as the most likely source to me is an economics behind a big decline in the risk premium. And certainly was true in the 1920s. Very few people owned stocks, and in order to own stocks, you had to own physical securities that you put in a safe deposit box. The index fund wasn't invented, the 401k wasn't invented, the mutual fund wasn't invented. So what we certainly have seen, we've seen 2 things. We've seen the economy get much less risky. Yes, financial crisis was bad, but it's nothing like the Great Depression. So sigma of delta C has gone down, and the risk of stock markets is now shared by a much greater group of people. Both of those things lower the equilibrium risk premium, lower the E of R, and that would raise the average price to dividend ratio. So if there is a trend in the price-dividend ratio, I would put it down to that force rather than taxes or other policies. But your question was time-varying coefficients. Yeah, great. In fact, a couple of papers have been written on this. I remember Martin Letow wrote a nice one and Sidney Ludvigsen with structural shifts in the dividend yield and things like that. The trouble is data. We've got 5 or 6 basically data points on the dividend yield about it going up and down. And once you start parceling it up, it's, can you really tell subsample stability? If you want shifting betas, you're essentially saying it's different in one sample than another. Well, we barely have a t-stat of 2.5 in the full sample. As Eva Welch has pointed out, it doesn't work that well in rolling regression out of samples. So trying to look for structural changes, subsample instabilities, time-varying betas, I'm worried that you're just mining the data for things that we just don't have enough data to tell. Now, and also, so there's a story for a shift in the level of the dividend yield. What's the story for the shift in the regression coefficient? Why would the dividend yield correspond now to more or less of expected returns versus dividend growth? I don't know, but I would certainly look for a story, a compelling story.
Right.
Yeah.
Yeah. There's a recent JFE that, for instance, just has a good state and bad state and lets lets the coefficient on dividend yield be different in recession type states than in boom type states. And they find, really different coefficients for lots of predictors. I don't know what's the economics. I guess whenever I see a constant coefficient, my question is always, why am I assuming it's constant? That almost seems like the strong assumption, as opposed to, why might it time vary?
Hold on just a second. So this time varying coefficient, you can also think of it. Here's an equation I wrote on the bottom of that page there. Return is dividend yield regression plus an interaction term of dividend yield and regression. So one way of thinking of a time varying coefficient on dividend yield, right? The time varying coefficient on dividend yield is just it's the combination of B and C here. It's the combination of the dividend yield and the interaction term. A time-varying coefficient on dividend yield is just like another regressor. And here we have the usual problem. We have so many data points, and we have 57 potential regressors, and off we go fishing. I'm not saying, one of those fish is a good fish. A lot of those fishes are fish. So it's certainly possible. So looked at either as we're adding another regressor that maybe helps improve the R-squared, maybe doesn't. Looked at as, we're parceling the sample into two regressions and non-regressions, fine, but that means the t in sigma over root t just got cut by a half. So it's going to be harder to detect these things. I don't want to discourage. They may be there. It's just, be careful of too much statistical fishing. Okay, onwards.
We have a new guest, a new student joined us. Why don't you introduce yourself?
Hello, everyone. You guys hear me okay?
Yes.
Yeah.
Okay. I'm Guoxing Shao. I'm working in a bank at Chicago. It's a beautiful day today. So I really enjoy this course. At the detriment of my free time and my other engagement, but it's been fun. So, John, I have some simple questions regarding, I think, this week. I read a little bit on chapter of the textbook. So, a couple of questions regarding the facts and the revision on those facts, right, based on earlier research and more recent research. The first one is, has anyone done research, say, on the Europe market or emerging market and validate those same facts?
So I'm sorry, on the emerging market, and which set of facts do you want to look at with emerging markets?
Well, you state the three facts, right? The predictability of the stock returns. What else?
Yeah.
Yeah. So yeah.
The answer is yes. And, I'm so grateful that so many people think that I'm a walking encyclopedia of finance. But Google Scholar was invented. I know Fama French did a couple of papers called International Evidence. One way to find papers is always go to Fama and French first, because they write good ones. So there's some international evidence on the value effect. The Moskowitz and Asness paper, Value and Momentum Everywhere, has some interesting international evidence on the value and momentum. I know the dividend yield stuff was replicated in other countries. That's a little more troublesome because, of course, are other countries really other countries? I don't mean that in an American imperialist way. I mean that since there's so much correlation in stock markets across countries, it's not clear you're really getting new evidence. I just saw Peter Couchis here at Stanford is doing dividend yield predictability in the 17th century, and he says the coefficients are the same as everywhere. Broadly, the answer is yes. Some things are an interesting fact I remember from Asness and Moskowitz, and there may be co-authors on there I'm forgetting. Sorry, guys. That momentum doesn't work in Japan, and value is much stronger in Japan. And a nice feature of that paper was to say, hey, value and momentum are strongly negatively correlated, So this is in a sense, it's a single observation, not a separate observation about countries. Certainly, anything, you know, to say something works in one country and doesn't work in another country is profoundly disturbing. You really would like patterns that survive to survive everywhere. Value, I think, does work everywhere. And then there's a huge emerging markets literature that my vague impression is that it's remarkable how similar asset markets are around the world in their statistical characteristics, despite huge differences in taxes, policies, and so forth. As over time, you know, the 1920s in the U.S., yeah, volatility was higher, but other things don't look very different. So, a long way of saying, yes, there are such papers, and good luck finding them.
Okay. Thank you. So, next question related to that is, you know, you stated, I mean, the first fact or the stock return are unpredictable. And later on, the fact become the short-term, right? The yearly, the monthly, the daily return are too unpredictable, right? Yet it also widely ignored. I mean, you look at this town, right? Most people are doing what? And trying to ignore that advice, right? And try to make something. So, what do you think the reasons are, right?
Well, let's see, two things. Of course, the same long-run predictability is there in the short run. Dividend yields predict in the short run as well as the long run. Just the R-squared is really low. You're not going to make any money off of that. So it is an integrated phenomenon at different horizons, but you're not going to make any money off of that. Yeah, I would pose this as the big puzzle for research. Now we do know that the average investor holds the market portfolio. So for everybody making money, there's somebody losing money. And the big puzzle of finance, I would say, is who are the suckers who are there losing money all the time? Why? This actually came up a while ago. There's this big argument of insider trading and how it's unfair to the little guy. Look, the little guy who's losing money to insiders is a very simple strategy. Don't trade. Buy the market portfolio. So it's kind of a puzzle that people don't do that. I would say, so in the big picture, at very high frequency, the mechanics of trading clearly lead to non-random walk behavior. And once you look at intraday data, we're very, very far off from random walk behavior. Now, of course, there's also transactions costs, so can you actually make money at it? It's an interesting question. And the bigger question, you know, the theory of the efficient market says prices incorporate information, but it doesn't say how prices incorporate information. And we have a theory for how prices incorporate information. It goes like this. I have some information. I say, I want to buy, and everyone else says, well, that's nice, but we only buy the index as a whole. And I say, well, I want to buy, I'll offer you more, and I keep offering more until the price reflects the information, and no trading volume takes place. That's not how the world works. So there's something about the mechanics of incorporating information and prices whereby the informed traders can make a little bit of money along the way. And we don't understand that really as academics. I think it's a fascinating feature. I think it does necessitate some non-random walk behavior at very high frequencies. Can't be too easy because then everyone would jump in and compete it away. So the basic picture of it's a very competitive market must remain true. But at high frequency, the picture of how information gets in the market, I think, is an interesting one. It's the best I'm going to be able to do off the cuff there. Why don't we, let's take a quick break from these deep questions. Nina and Adam had some forum-type questions on the mechanics of the class, which I do want to make sure we get to this week. It's too much fun to just sit and chat about finance. But let's make sure everyone understands how to do the problem sets and what the lectures are about.
Definitely. I have a question from Anonymous on sort of general to homework 2. I think that this student is having some problem figuring out what a covariance matrix is. He or she asks us how to compute the covariance matrix sigma, and what are the elements in this matrix, what do they represent? So this is sort of maybe a step a little bit back from the big philosophy, but maybe if you could comment on what is this and why do we do it?
Well, help me to understand the question. The mechanics, I use MATLAB, and That's how you compute a covariance matrix. Sigma equals cov of x, where what I mean, where x here is organized as a it's a vector. You know, put your for example, returns. You might put the returns in a vector that's like n or 25 wide and t or about 600 long. You just go cov of x and you get the covariance matrix. What is the covariance matrix? It has variances on the diagonal. So typical. I don't know if you don't know what a covariance matrix is. I guess me putting a bunch of Greek letters in a square isn't going to really help. But I put a bunch of Greek letters in a square on the diagonals of the variances of the elements. On the off diagonals are the individual covariances, which tells you how likely it is that A goes up and B goes up at the same time. Now, other than that, Adam, Nina, do you understand this question well enough? Well, what's the confusion here, and how can we help to address it?
I think Anonymous refers to the questions 3 to 5 in the homework on cross-sectional regression. It is asked to compute the standard error of lambda in the cross-sectional regression. And we have different formulas, different ways to compute this covariance of lambda estimates based on different assumptions, and probably Anonymous is confused how to implement those formulas. And
so this might refer to the question that Nancy is asking right below. Nancy Hammond asks us if we could walk through what is called equation 1212 in the textbook on page 237.
Let that, Nina, can you focus that up? Yeah. And let's see, Adam, can you make it so people see Nina?
Yeah, everybody's seeing Nina. Charlie, do you see Nina now?
I see you right now. Oh, there it is.
I don't see Nina because I don't remember this equation. How do I see Nina? Oh, I got Nina. I just have to click on it. Okay, so Nina's not focusing.
Can you see equation 1212?
The problem is your computer. Back up a little because it's not focusing on the book.
What if I do it? Can you see my screen?
Let's try Adam. Oh yeah, Adam's is working. Well, it was working. Totally real steady. Okay, there we go. Okay, so we got a beta prime, beta inverse, beta sigma, beta prime, beta inverse, and a sigma f. Everyone look at equation 1212. That's the important one. Okay, there's two sigmas in here. And first, let's look at the one on the far right, sigma f. Now, this is a formula that involves multiple factors. Let's take the case of the capital asset pricing model. That would just, in the capital asset pricing model, there's a single factor, the market. So that would be sigma squared, little sigma squared. That would be the variance of the market return over t. Aha! Wait a minute. Where have we seen sigma over root t before? Well, that's just right. That is the variance of the. That's our formula for the standard error of the mean. And lambda is the factor risk premium. It's the mean of the market return in the case of the CAPM. So you're finding sigma over root t. That shouldn't surprise you. And by the way, this is how you read formulas. Always go back to a special case and understand how the formula is generalized in the special case. Now, sigma sub f over t, what's that got to be in there? Well, when you have multiple factors, we're looking for the covariance matrix of the mean return on these factors, like HML and SNB. So that's going to tell you not just the variance of the estimated lambda, but the covariance. How likely is it that your SNB and your HML market prices of risk are unusually high together? So that's just sigma over root t. Easy. Now, the second one. What's the sigma in the middle of the beta? It's not me. Okay. What's the sigma in the middle of beta doing? That is the variance-covariance matrix of the residuals. The return equals beta factor plus residuals. That's the variance-covariance matrix of the residuals. What's that doing in there? That's the formula for the standard error of an OLS regression, where the betas are the right-hand variables. If you remember x prime x inverse times sigma sorts of things, well, the beta is the x prime x. So that formula there is the formula for the standard deviation of an estimated coefficient of a regression estimate, where the betas are the x's, the betas are the right-hand variables, and sigma over t is the covariance matrix of the residuals in the cross-sectional regression, which comes from the covariance matrix of the residuals in the time series regression. Kind of a cool fact. Sigma over t is the covariance matrix of the alphas. It's the covariance matrix of the residuals in the cross-sectional regression. So that's it. It's kind of cool. You just add up the two obvious things. If you thought, okay, you can put that down now, and everybody come back to me for a second. Beta versus ER. What we're doing here is a cross-sectional regression of expected returns on betas, and there's the lambda. Now, what would your guesses for sigma of lambda hat be? How do we figure out the standard error of that thing? Well, you'd have two guesses. Your first guess would be, let's just use the OLS regression formula. The OLS regression formula takes into account the fact that the residuals in this regression, the E of R equals beta lambda plus alpha, the alphas, the residuals in that regression, those are correlated with each other. Well, the first element of that formula was just, that's the OLS formula when residuals are correlated with each other. Your second guess would be, oh, wait a minute, I remember that lambda equals expected value of the factor when the factor is a return. So why don't we guess, oh, I'll just use sigma over root t. The sigma squared of the factor over root t. And the brilliant thing is you just add those two guesses together, and that's the answer. So that's what that formula means, and the two covariance matrices are the covariance matrices. One's the covariance matrix of the residuals, the other is the covariance matrix of the factors. So have I answered what they are and why it all makes sense at horrendously great length?
I think so.
Yes, I think there was a confusion also in the forum about the difference in the covariance matrices, in the signs for the covariance matrices. That if you have F, then it means that it's covariance matrix of factor, and if you don't have the subscript F, it's the covariance matrix of the errors from the time series regression.
That's exactly right. Sigma F is the covariance matrix of the factors. Sigma is the covariance matrix of the errors from the time series regression. Yep. Sorry, I'm doing my best with the notation. Okay, do we have anything else pressing on the forums? I really want, I want these problem sets to be.
I have a question on testing the asset pricing models, one versus another one. There was a video on that in week 2, and there were the right ways to test the models, new model versus existing models, and the wrong ways to do that. And I was thinking about one alternative way to do that, and I wanted to ask you, what do you think, whether this would be a wrong or a right way to do that? Yeah. So if you run the returns on one set of factors, and you have another regression of returns when you run it on the other set of factors, you can put them in the GMF framework together and test the hypothesis that the intercept coefficients are equal. So if the intercepts from these two regressions are equal under some significance assumptions, then that would mean that those two models are the same. If the coefficients are not equal, then probably the second model has some factors which add something on top of the other model.
Nope. Were those two? Didn't quite focus. Were those both time series regressions that you ran down? So you had a time series regression on one set of factors and a time series regression.
Yes. Yes.
And so you've got exactly the central point here. let's review for the students the points. One, the central question here is the alphas. Well, that doesn't need to be the central question. You could be asking about variance factors, but we're asking about which factors are important for understanding mean returns. So the question is, which set of factors produces lower alphas? Now, I don't think we want the alphas to be the same. I think we want the alphas to be lower. So the question is, which set of alphas lower factors? What I was doing in the book was essentially advocating let's put them both in together and then test the restriction. If I remove one set of factors, does the alphas go up, and how much do they go up? Or if I add a second set of factors, do the alphas go down? And you're doing something I think there's something very good to what you're saying, which is let's think about the system with one and think about the system with just the others, but then let's ask the question, which of those two produces lower alphas? I think that the right question is, so there's a general one that needs both, and it's easy to do I know how to do a likelihood ratio test, essentially. Does removing one make the alphas go up significantly? And I think we can compare one versus the other. Does one have lower alphas than the other? But I would do it. It's not about are they equal. Are the alphas lower with just one set of factors versus another? Balance fishing.
My thought was, why not to do it in the GMF framework, putting two equations together and not to look at them separately, one model with one set of factors, another model with additional factor, and to see how alphas differ, but rather to have them all together in the same GMM setting.
Yeah, although what we're doing is really a test. You can you can do sort of JT tests of restrictions. Is the restricted model different? So as usual, Nina, you've asked a harder question than I'm going to be able to answer right off the top. I think these are tests. By the way, a reason I made the fuss about it and did the video, these are tests that people don't do for reasons I don't understand. People seem to like to do tests. That video was mostly a reaction to reading so many papers that they test the factor risk premiums. And so they say, oh, the model fits because the factor risk premium is tested. Whereas in fact, it's about the alphas. And they test one model versus another based on the factor risk premiums, not does adding the new factors lower the alphas. So mostly it was just, hey, we need to think about, do things lower the alphas? And there's a lot of ways to do it, and it's just kind of interesting that nobody's done any of them. So I think the line of thought is good. Always do GMM when possible because it's much easier than likelihood, and it lets you put in sort of economically interesting things like, are we fishing? It lets you invent tests. I like what you're doing. Don't just throw them all in together because you're going to get too much fishing in some sense. Let's think about one versus the other. But the issue is, are the alphas lower with just one set of factors? And so you and I, let's follow up, you and me. You've asked something too complicated for me to, well, it's too subtle for me to figure out right when we're sitting down. Unless one of the other guys here has the answer to this question. Adam, I'll put you on the spot.
Good. In that case, I will divert the question and take another one from the forum instead. We have a question from Badia, who's confused about one of your lectures. In particular, the one-period identity lectures. In this lecture, remember, you first take the log, so to get a linearized relationship between returns and dividends. And then you say, so Badia writes, in this video, in deriving the linearized present value formula, the professor asserts that the identity equation is held exposed. It also must be held ex ante.
Yes.
I have a difficulty understanding the logic behind it, and it would be great to have the professor's take on this.
So I think this was the one-period identity, right? Not the
Correct.
Multi-period identity. Well, it's also true of the multi-period. I'm writing an equation down. 1 equals delta dt plus 1 minus rho dt plus 1 plus dp. Let's look at these identities. And actually, I have a third identity. Sorry, I got to write these equations offline. Okay, I've got my questions written down. I think the identity that she was asking about is the top one. That is the log identity when there is no future price. So we just got one dividend and one DP, correct? And that holds ex post. The second equation I wrote up is the standard Campbell-Schiller linearized identity, where we in fact have a future price. And the third equation I wrote is the one period case without any of these logs, which I think the logs is what's confusing people. So if everyone will remember, in order to derive this one period identity, I simply took logs of that thing and rearranged it a little bit. So let's do the point in the context of this, because I think here we see it clearest. Here's the return, and that's just the definition of return. Return is future price plus future dividend over current price, right? No explanation, no expectations, no nothing. That's just the definition of return. Along for the ride? Everybody cheer. Yeah. Okay. Now, let's rearrange that. Let's bring the price to the left and the return on the bottom. So now, price equals future price plus future dividend over future return. That's in essence what we've been doing. So that looks a lot like the Campbell-Schiller price identity. It's just a very simple version. It tells you can express today's price as the future value discounted by the ex post rate of return. Now that holds ex post. So this ex post, right? That is a relationship that holds ex post. Given today's price, if tomorrow's price or dividend are higher, then tomorrow's return is going to be higher. And the numerator and denominator, randomness in the numerator and denominator will always cancel each other. Well, that's just the definition of return. The way you get a higher return is by getting a higher price or a higher dividend. So that's the sense in which this is an ex post relationship. And really, that one's familiar. That's just the log of that one, and that's just the intertemporal version of that one. Now, given that something holds ex post, given that any fluctuation in the top and the bottom will always offset each other, then I can always take the expected value of something that holds ex post, and it holds ex ante. And in other words, I mean, there's ex post variation in price and dividend. There's ex post variation in return, but there's never ex post variation in the ratio. That's why I can take expectation, because the whole thing doesn't change. And that's the same thing here. When I take expected values at time t of the top equation, returns and dividends each vary, but return minus dividend growth never varies. So taking expectation, I mean, all we're doing here is taking expectation of a number. Maybe I should have said that in the video. If you have both of them in there, you're just taking expectation of the numbers. That's why ex post holds ex ante.
Is there a minus in your very first top equation?
Oh, probably.
So return tomorrow is dividend growth minus price dividend ratio.
Thank you. Return tomorrow is dividend growth minus the dividend. Yes, thank you very much, Adam. Did I screw up the second one?
Let's see.
What is it, like 9:30 in the morning and we can't do sines?
Depends on what time zone you're in.
I think that's a plus, Adam.
Wait, so return tomorrow without logs is dt plus 1 over pt, right? I'm looking at your lecture here.
Okay, the lecture notes has the sign right, so we'll all get the sign right. The point here was about, let's just go down to that. I got the signs right on that bottom equation. That explains this concept about ex post and ex ante, I hope, correctly. It's kind of magic. The central idea is just that the returns and the dividend growth curve are perfectly negatively correlated. Of course, the way you get return is by getting dividend growth. So these are identities, and they do hold ex post as well as ex ante. Little magic when you first see it, and then lovely magic after a while. Okay, next. I'm going to derail that, which was going nowhere.
Well, I have a week one question.
Okay, go for it. Yeah, we need to hear from our visitors.
That's kind of what I do. So it's weird because being so young, you sort of read old papers and new papers at the same time, and you make up this fake history. So I'm just curious. So to me, it looks like cross-sectional tests are falling out of favor, and for not so good reasons. And I put it on this basically the Shanken paper. The Llewellyn Nagel Shanken wrote this paper and showed that we did it wrong for like a long time. We had test assets with a strong factor structure, and we got a lot of false positives, a lot of models that looked good because we were running really weak tests. And and since now you see, so instance, when Lu Zhang writes a paper or Nobi Marks writes a paper, they take 180 test assets and they run time series tests. And I object on aesthetic grounds. Like I like to sort of see how a model prices everything at once. And so I guess my question is, how do we bring cross-sectional tests back? Like, what are the right recommendations? Like, I even remember the first. We had these competing goals. We need to have something to price, right? So we need differences in expected returns. But following the Llewellyn Nagel Shanken critique, we need to break the strong factor structure of test assets, right? So, should we add industries? But then do industries have constant betas, right? Which that's the whole reason we sort to begin with. So I guess I'm just curious on how you're following that literature. You probably don't even see it that way because we're looking from different perspectives. But
no, I do. I mean, empirically, what happened is, cross-sectional. Even Fama and French in their 92 and 93 papers on value, they started with cross-sectional regressions of individual companies and then they moved to the portfolios and the time series regressions. And the way things work is whatever Fama and Fama and French do is what everyone else does afterwards. So they started doing time series regressions, and then everyone started doing time series regressions. I think you see in the most recent papers the difficulties of doing this portfolio sorting and time series regression technique is that once you have 3, 4, 5, 6 different factors, 3, 4, 5, 6 different portfolio sorts, the n by n method just kind of the tables start to explode and it's hard to figure out what to do. So good methodology follows from the question you're asking and the data set you have. So I don't think you can say ex ante, time series good, cross section bad. The time series regression is the GLS cross sectional regression. These are identical. Time series regression just runs. That's why we spend so much time thinking about it. The time series regression fits the implied cross section. The time series regression fits the implied cross section directly through the factor. The cross sectional regression allows something else. The cross sectional regression allows potentially an alpha on the factor and the risk-free rate. We've kind of been through those things. Cross-sectional regressions are useful if the factor might be mismeasured. Hey, maybe the factors are mismeasured, and you might want to let that happen. It shouldn't really matter too much what you use. That's another central law. I think where we're going in the future is something totally different, and that's my speculations in discount rates is my thoughts on the subject. We've got this multi-dimensional vector of characteristics. We think asset prices are a function of characteristics. You Charlie, wrote this beautiful paper on how we can even bring that multidimensional vector of characteristics down to a univariate thing on which characteristics describe expected returns. Our job is to do functional asset pricing, and I don't know quite how to do it yet, but surely the answer is not. We're going to bless holy water on a technique from the 1960s, or bless a different holy water on the technique from the early 1970s. We're going to do something new, different, simple, intuitive, and appropriate to the problem at hand. And I'll stop waffling and we'll get on to a real question.
I have a question on double sorting. Is there a difference between doing independent sorting, so sorting on one characteristic independently and on the other characteristic independently, and then just looking at intersection, as compared to first sorting by one characteristic to several portfolios, and then within each portfolio to do the second sorting? Yes.
Now this is the sorting kind of made sense with one portfolio. When you have two characteristics, yes, the order in which you sort things matter. here again, I think the right way to think of it. So why did Fama and French sort? It was when they were doing the first thing, it was beautifully intuitive. You can see what they're doing, especially with a scalar. So if you're sorting by book, it's all things generalize, and then they get too big. If you're sorting by book to market, then you're putting things into portfolio by book to market. Here's what Fama and French basically did. They sort into portfolios by book to market. They plot expected returns. Boy, that made sense because they didn't want to get parametric, right? We talked about parametric versus non-parametric. It's a beautiful, very simple non-parametric estimate of how book to market affects expected returns. Well, now we want two-dimensional sorts. So now you sort in two ways, and it gets kind of complicated. And in those five-factor models, you want five-dimensional sorts. And you discover that you're running out of companies in each bin, that which way you sort first versus the other makes a difference. Well, what do we do about that? I think we got to go back and think, what are you doing with a two-dimensional sort? What you're really doing is you're trying to understand the function. How does expected return depend on size and book to market? You really are doing a non-parametric estimate of that function. If you think about it that way, then you don't want to sort into portfolios first one and then another. Thought of as a non-parametric thing, you just want to, at each bell point, you want to take a look at the nearby, in some sense, stocks and see what they are. You might want to think about parametric functions, but I think once you get into 3, 4, 5 factors, doing it in terms of rigid portfolio search, which is very intuitive early on, I think kind of falls apart. I think thinking of it as a non-parametric estimator, where you just look at at the nearby stocks in this characteristic space, I think that's going to be the way to do it.
So independent sorting.
There's nothing that says every stock must be in only one portfolio. So why do we do that kind of non-parametric estimate versus the kind of non-parametric estimate? If you do a statistics class, what they will teach you to do is they'll teach you to do a non-parametric estimate of expected returns versus book-to-market ratio, where we use smooth histograms and the histograms overlap. Why not? Well, this is nice and intuitive, but if you go to multiple variables, I think we're going to have to use overlapping smooth histograms and think about it the way a non-parametric estimator would think about it. Now, why not? What's difficult about that? Well, if you're doing the first paper in this series, that's awfully hard for people to understand. It looks like a big black box. It looks like you're cooking the books. This is so transparent and simple. That's why Fama and French do things with these simple methods. But there comes a point where you just can't do 6, 7, 8 variables with simple methods. That's my guess. The answer, of course, is write a paper and have everyone cite you. Be like Fama and French. Back to, or we're supposed to be talking about stuff in this class.
Yeah, before we wrap up, let me just correct myself before. I think the method I did was with price dividend ratios, so PD, and I think you wrote DP dividend price. Is that correct? So your original equation was right, and my correction, the minus, was wrong.
Okay.
In the lecture.
Sorry. Go ahead.
So, note to myself and everyone else listening in, there's a difference between DP and PD.
Let me just cheer on that. There is a difference between DP and PD. I've kind of waffled about which one I like to use, and that's why sometimes it's one and sometimes the other. PD has, that's just a sign. There's a plus sign and a minus sign. But PD, that connects with Schiller and the variance of prices, and this idea that there's too much price volatility. So that's why I was originally thinking in terms of, yeah, PD, that's the way to do it. When we do the return regressions, we tend to do return on DP, because the dividend to price is one component of return. It has the units of return. So that's why the signs are positive. Positive dividend yield means positive return. So DP is kind of nice when you're thinking about the return regressions. I've sort of moved to standardizing on doing most stuff in terms of DP and presuming you're smart enough to figure out that the variance of DP is the same as the variance of PD, and therefore the connection to prices. But they are different, and that's why you see some in one place and some in the other place.
Yes, I think this was very useful because I got sometimes confused by PD or DP.
Yeah. Well, as you can tell, I've been waffling about which to use. And this is actually an important lesson. You know, making clear what you're doing is very hard. So, you know, I have spent several years thinking about should I be doing this as DP or DP, but making clear to what people are people reading it, you know, that little sign change can make a difference. We should ask our visitors for another question. We've kind of trained.
Well, I have another question, like another crazy question that'll make you angry. It's not, but those were my favorite questions watching when I took it the very first time. So, so I guess the question is, when I was watching your lecture on Fama French's, you know, evaluating managers by looking at the distribution, I wondered if we should look at asset pricing models this way. Like, what if you put CAPM against all the stocks and looked at the distribution of alpha? Would it, in a sense, tell you if there's like a, you know, missing pricing, or are we overfitting the data by adding more factors? You know, if you added value or SMB, HML, SMB, would you get closer? Or maybe you'd even, you know, maybe if you thought that those were sort of ex post data mined, you'd overfit and you'd have smaller alphas than you'd even expect. But maybe that's crazy. I don't know.
It's not. No, crazy ideas are often, they're either wrong or they're wrong in different ways. I do think, back to your larger methodological question, I do think we should end up back on individual stocks using the characteristics as instruments rather than forming portfolios. I think this is a step in that direction. Yeah, how can we use that insight for individual stocks? Maybe to answer this, you know, the John Hand Campbell Harvey observation, there's 340 characteristics now that people think matter. So how many of those characteristics, a big issue is how many of these characteristics are just due to fishing. 340 published papers on sorting on X forecast stock returns. Surely some of those are due to chance. Perhaps that's a place where this approach, how many, rather than fishing for one and seeing as one significant, what's the joint distribution of characteristics and returns, and how many are we likely to find by chance? That's a brilliant idea. I can't think about how to implement that right now, but
Me neither.
But you've got something. The transition in mutual funds was from I dream up some clever sorting variable, and then I sort and see if things go forward, and we fight about that. Stocks are light years ahead in that the dream up sorting variables has gone to at least 340. That's just the published ones, and we're still in this methodology: dream up sorting variables, see if you can forecast returns. So can't we do something similar? How many such sorts should there be that seem significant? If there truly aren't any, are we seeing, you know, to what extent are we seeing? That's deeply what Cam Harvey's paper is about. How much of this is due to chance? He has this great paper saying, well, maybe we need to have stats of 3. I don't know. Maybe that just means you fish even harder. So I'll put that in the brilliant ideas that I don't know quite how to implement yet, but I think there's something very deep there. Make that transition for the stock one too.
Right, and I think the other thing is, I mean, we've been in a sense more successful because a lot of times we sorted mutual fund managers, and you know, in a sense it didn't work, or we just got value back or something. But if I did give you a sort on mutual fund managers, you know, every once in a while you'll see one, you know, the school you graduated from, and you know, you're a little skeptical that if you tried 100 variables, yeah, you came up with a sort and you got alphas, right? So, but almost going back to the alphas, it seems like maybe it gets you back to the original. I don't know. Maybe I have to think about it.
No, it's very similar. But the only way I can think about it would be to be simulating the joint distribution of returns and characteristics, and then how many of those characteristics would show up being successful. So, because we don't do, well, I don't know. Let's just leave that as
fair enough.
Is there a better way? Is a deep problem of how do we address the fishing for characteristics, and is there a way to do this common French philosophy of not having to name characters? Well, Guoxing, do you have another question? I hope I pronounced your name right.
Guoqing, thanks, John. Okay. Yeah, I do have a maybe another concrete question on the dividends yield ratio. So I see it has to do with this identity derivation. right? So in the what do you call it, Campbell-Shiller identity derivation, I think you did a Taylor series where there's a generic DP appears. So that DP is some sort of a persistent ratio that empirically constant over time. I've not fully understand. I think you have some word later on in the book about that persistence. So I'm wondering if you can comment on that.
Yeah, so I can't, let's see, I'm not going to dredge up the formula right while I'm here. But the idea is, hold on, I'm writing an equation. We're doing a nonlinear, we're doing a linearization of a nonlinear function, right? And I think, in fact, the important nonlinear function was a log of 1 plus e to the p minus d. That was the problem was the log of 1 plus x isn't the same, right? That was the important nonlinearization. And so we linearized, we took our first order Taylor expansion to that function, and the big P and the big D that didn't have time subscripts on them, they were the point of linearization. So you choose, in order to do this, you choose that it was just the point at which we choose to linearize this function. So now, what point should you choose to linearize this function? Well, obviously, you want the data to be roughly around that function, that point. So the tradition in this literature is to use the sample mean, to use E of D over P to linearize around the sample mean and use that for the E of D over P. That's a tradition. It's not necessary. So that, for example, there's nothing wrong on using this with two different stocks that have different mean D over P's, but using the same linearization point. Because the central idea is you want the data to be distributed somewhere near this linearization point, but it doesn't have to be centered on it. So it is not necessary to use the mean. It's just choose some linearization point that's kind of representative of what's in your sample, and you'll be okay. The closer the data is, the more accurate. So summary, the P and the D in that formula are fixed numbers. They are the linearization point around which you take this linear approximation. And that's all they are. Tradition is use the sample means for them, but it's not necessary to do that if you don't feel like it. And empirically, anything between about 2 to 5% D over P yields about the same answer. So hopefully the rho, the rho in rho to the J should be something like 0.96, 0.98. Don't overdo it. Not 0.6, not 1.5, and it's pretty much going to work out.
Okay.
Good. There is a short question in the forum, very short one. It's about the second video on Carhart, where you show a graph of hedge fund returns, and you mentioned there are 27 factors on the right-hand side. What is the reference for this paper?
I made it up. So that was a joke. Sorry. But let me state the serious point. In the beginning, there was chaos. Then came the CAPM, the one-factor model, and everyone said, aha, I see all these strategies for making money are because you've exposed yourself to market beta. And all the anomalies went back in the box where they should be. Together with that, there was pretty much a one-factor model of returns. You think about returns, you think about the market. Then, of course, we realize there's more factors than the variance. So mid-1970s, there's the market as the first factor, but there's industry factors, there's interest rate factors. There's other things that cause co-movement, but they aren't really priced. So late 1970s, everyone says there's one priced factor, one way to make money by exposing yourself to market risk. It's a bunch of unpriced factors in the covariance matrix, useful for risk management. But every time someone comes with some clever strategy, oh, you secretly exposed yourself to beta. Along comes value, and first comes small, then comes value. Oh boy, here's ways of earning money that don't involve taking on market risk. Looks like big anomalies. What do we do about this? And the earnings price ratio, all the factors and multi-factor anomalies, all those strategies came up. The sales growth trick, the long-run mean reversion. What do we do? All these different ways of making money, and they're not market beta. We look like we have it by multi-factor anomalies. We've got 9 or 10 strategies for making money that aren't market beta, and it looks like the world is falling apart. Enter Fama in French, no. Give me 3 factors, HML, SMB, and the market. All these other anomalies are just ways of getting beta on these 3 factors. And coincidentally, these 3 factors also absorb a lot of co-movement. So now we got SMB, HML, and the market acting as the market did in the 1970s. 3 big factors that account for lots of the co-movement. There's still industry and other co-movement stuff. And 3 big factors, exposure to which explains all the anomalies of the era. Oh, except momentum. So that's factor 4. Momentum acts as a factor 2 in exactly the same way. But since then, just think of the number of ones. Now we got this earnings quality thing, accruals, investment. About, as we saw, about at least 4 or 5 of the accounting factors are real. They're independent of size and book to market. We've got the international carry trade. We've got the bond term structure factors. We've got writing put options, and on and on. So we live back in a world where there's, I was making up the number 27, it was probably right. Certainly the Cam Harvey survey that I alluded to had 340 extra variables, each of which seem like a way to earn money but are not compensation for market beta, SML, or HMB. So the Pandora's box is open again. So that's what I meant by the 27 factors. We seem to have size, market, size, book to market, writing put options, carry trade, earnings quality, momentum, and at least a couple more that are sources of systematic risk that seem to generate a premium orthogonal to each other. One isn't all explained by the other. So those are the 27 dimensions of systematic risk. Boy, it would be nice if we could lower the dimensionality, or maybe we just got to get used to the fact that it's a complex world and there's many, many dimensions of systematic risk. That's the job for research. The great thing about teaching a PhD class is I get to end it by saying, well, I don't know, go write a thesis on it.
On that,
okay, we're done for the week?
Yeah, on that note, let me just wrap up. There are a couple of other questions asking for references on precisely what you just said. So both Mikhail and Hua Sun asked for references or discussion of the Fama French 5-factor model or Hu Chen Zhang's Q-factor model. I will post in the forum one reference that I think is very good if you're interested in factor investing. Andrew Ng at Columbia has just written a book about this. And there's a blog post at AQR, a hedge fund that does research in factor investing. So all of you guys can read more there.
All right. Good. Thank you, everybody. And see you next week.
Bye.
Bye.